$5,019. That's the number you need to understand right now, because as of early this morning, gold just got absolutely punished down to $5,019 per ounce, a drop of roughly 1.5% in a single session, and the financial media is screaming that rate cut bets are the culprit. Don't believe it, not yet, because if you look at just the headline, gold drops on Fed rate cut expectations, you will completely miss what is actually happening underneath the surface, and that misunderstanding could cost you enormously in the weeks ahead. So before anyone starts panic selling, before anyone starts chest bumping about gold being over, and before you let the talking heads on CNBC tell you this is the beginning of a reversal, I need to take you through everything that has happened in the last 2 weeks, why gold is doing this exact thing right now, and, more importantly, what history says happens next to people who confuse a short-term technical pullback with a structural collapse. Because those are two wildly different things, and right now, most people watching gold charts cannot tell the difference. By the end of this video, you will understand exactly why gold fell today, why it's going to keep confusing people over the next several weeks, what the big institutions are actually doing behind the scenes, and what the historical patterns from the 1970s, from 2008, and from 2011 tell us is coming next. Stick with me, because this is one of those moments where getting clarity is everything. Let me start with what actually happened. According to spot price data from Kitco and JM Bullion, gold opened this week near the $5,100 level and has now been sliding for 2 consecutive weeks, sitting at approximately $5,023 to $5,042, depending on which feed you're watching. Just 10 days ago, gold was printing near $5,181 per ounce. So we've seen roughly $160 to $170 wiped off the price in less than 2 weeks, and the financial press wants you to think this is about the Fed. Let me show you why that explanation is incomplete to the point of being misleading. Here's what's actually going on. According to Bloomberg and multiple commodity analysts, the real catalyst for gold's weakness began on approximately February 28, 2026, when the United States and Israel launched airstrikes on Iran, triggering what some analysts have now dubbed the 12-day war. The Strait of Hormuz, which according to the U.S. Energy Information Administration handles roughly 20% of the world's seaborne oil supply, that's approximately 20 million barrels of oil every single day, is now effectively disrupted. Tanker traffic through that choke point fell from an average of 24 transits per day to just 4 in 1 week, according to a March 9th report from Financial Content. Brent crude exploded past $100 per barrel, then $115, and as of this week is hovering around $100 per barrel. Now here's the thing everyone is getting backwards. That kind of energy shock is classically inflationary. Oil at $100 a barrel, with the Strait of Hormuz partially blockaded, means fertilizer prices go up, plastics go up, transport costs go up, food prices go up. Everything priced in energy goes up. And you would think, you would absolutely expect, that gold, the world's premier inflation hedge, would be screaming higher on this news. Instead, it's been falling. So what is happening? Here's what nobody is telling you, and this is the key insight that changes everything. Gold doesn't just respond to inflation. Gold responds to the real interest rate environment, meaning what inflation-adjusted returns look like on competing assets like bonds and cash. And right now, the market has completely repriced Fed rate cut expectations. According to CME FedWatch data, as of this week, market participants are pricing a less than 5% probability of a rate cut at the March 18th FOMC meeting. That meeting happens this coming Wednesday. 95% of traders expect rates to hold at 3.50 to 3.75%. And Goldman Sachs economists, in a note published just this week cited by CNBC, actually pushed back their forecast for the next rate cut all the way to September, and even that is now being questioned. Traders have in some cases taken even a September cut off the table entirely, and are now pricing only 1 cut, potentially in December. Think about what that means. Oil is making everything more expensive, which means the Fed cannot cut rates, which means Treasury bonds stay yielding real positive returns, which means there is more of a cost to holding gold, which earns you nothing. That's the mechanical explanation for the drop. It's not that gold is broken, it's not that the bull market is over. It's that in the very short term, rising oil prices created a paradox where inflation fears actually hurt gold because they make rate cuts less likely. Jim Wyckoff, senior analyst at Kitco Metals, was quoted by CNBC this week saying exactly this, that if hot inflation numbers come in, that's really going to put the Federal Reserve into a quandary and could push gold lower. Quick message for the folks who haven't subscribed yet. My analytics show about 3 out of every 4 people watching right now are not subscribed. If this kind of analysis, going deeper than just the headline, explaining the mechanics that most channels gloss over, is actually cutting through the noise for you today, hit that subscribe button. That's how I track who the committed community is. It helps me know what to keep covering, and it helps the algorithm show this to more people who genuinely need to hear it. Now, let me show you something that should shock you. Because while all of this short-term noise is happening, while gold is getting sold down because traders are pushing back rate cut bets, the underlying structural demand for gold is more powerful than at any point in modern financial history. And I mean that literally. I am not exaggerating for effect. According to the World Gold Council's full year 2025 Gold Demand Trends Report, released in January of 2026, total gold demand in 2025 exceeded 5,000 tons for the first time in recorded history. 5,000 tons. In dollar terms, that translated to an unprecedented $555 billion of demand, a 45% increase year over year. During 2025, gold set 53 separate all-time price records. Not one record, not 10 records, 53. That is more than one new all-time high per week on average for the entire year. Central banks alone bought 863 tons of gold in 2025. That comes on the heels of 3 consecutive years, 2022, 2023, and 2024, where central banks purchased over 1,000 tons per year. According to data compiled by Visual Capitalist using World Gold Council figures, central bank purchases from 2022 to 2024 totaled 3,220 tons. That is 104% above the 2014 to 2016 total for the same 3-year period. They literally more than doubled their gold buying pace. Who is buying? Poland's National Bank led the pack in 2025, adding 102 tons and targeting 30% of total reserves in gold. And their governor has announced plans to increase holdings to 700 tons for what he described as national security reasons. The National Bank of Kazakhstan hit its highest annual buying on record. Brazil's central bank re-entered the gold market for the first time since 2021. 22 central bank institutions all added meaningful gold positions in 2025. Let me put that in perspective with a pattern that has played out before. 3 times, in fact, in recent history. And I want you to pay very close attention, because this is exactly the framework you need to understand what's happening right now. In 1979 and 1980, gold went through one of its most dramatic bull markets in modern history. The backdrop was geopolitical turmoil in the Middle East, specifically the Iranian Revolution and the Soviet invasion of Afghanistan, combined with runaway oil prices and inflation that the Fed was struggling to contain. Gold ran from around $250 per ounce to an intraday high of $850 per ounce in January 1980. But here is what most people forget. That run was not a straight line up. During that bull market, gold had violent corrections of 15, 20, even 25%, drops that looked, in the moment, like the bull market was ending. They were not. They were shakeouts. The investors who sold during those dips missed the full run. The ones who understood the structural forces, inflation, geopolitical risk, dollar weakness, held through the volatility and saw generational returns. The second pattern, 2008. When Lehman Brothers collapsed in September 2008, gold initially dropped nearly 30%. Think about that. The worst financial crisis since the Great Depression, and gold went down 30%. The reason? Exactly the same as today. A flight to liquidity, a scramble for cash, dollar strength as investors sold everything to cover margin calls. Analysts at the time were declaring gold's bull market dead. Every headline was bearish. Then, from late 2008 forward, gold went from roughly $700 per ounce all the way to $1,921 per ounce in September 2011, a 174% gain from the panic lows. Third pattern, 2011 to 2012. After gold peaked at $1,921, it corrected roughly 45% over the following years. But the people who understood that the structural drivers, central bank buying, dollar debasement, geopolitical uncertainty, had not changed, used those corrections to accumulate. And of course, what happened next? Gold eventually broke that $1,921 record in August 2020, then shattered it repeatedly on the way to $5,589 per ounce earlier in 2026. The pattern is always the same. Short-term technical pullbacks driven by dollar strength and rate expectations get confused with structural reversals. The people who confuse the two get shaken out at exactly the wrong time. Now, right now in March 2026, We are watching that exact playbook unfold in real time. Bob Haberkorn, senior market strategist at RJO Futures, told Reuters directly this week, "The move lower in gold appears to be driven by a flight to liquidity, a flight to cash. We have a strong dollar and bond yields trading higher. However, this dip in prices is likely to be short-lived, and flight to safety flows driven by geopolitical risk should support higher gold and silver prices." Let me add even more evidence on top of that, because the institutional community's actual price targets for gold right now are extraordinary. JPMorgan, one of the largest banks in the world, with more insight into institutional flows than virtually any other institution on the planet, has a year-end 2026 target for gold of $6,300 per ounce. Deutsche Bank is standing by a $6,000 year-end target. These are not fringe analysts. These are the people who move the market, and they are not panicking about a 2% pullback. They are, if anything, watching this dip as a potential entry point. But here's where it gets truly interesting. And stick with me because this next part is critical. The current drop in gold is happening while the structural demand environment has arguably never been stronger. The World Gold Council confirmed that gold ETF inflows hit 801 tons in 2025, the second highest on record. Bar and coin demand hit a 12-year high. And JPMorgan's research desk, again this is their official forecasting, is projecting central bank and investor demand to average 585 tons per quarter in 2026. That's their base case for sustained buying throughout the entire year. Meanwhile, Commerzbank stated in a note this week, and I'm paraphrasing, that expectations of a more restrictive monetary policy are the main reason gold has come under pressure. Translation: this is a rate narrative problem, not a demand problem. The demand is still there. The buying is still there. The structural reasons that drove gold from $2,989 per ounce to $5,589 per ounce in a single year, those reasons have not gone away. In fact, several of them have gotten stronger. Consider oil. Ross Norman, CEO of Metals Daily, told CNBC this week that rising oil prices could lead to prolonged inflation and potentially higher interest rates as central banks struggle to contain the fallout from a closure of the Strait of Hormuz. He is exactly right. But here is the paradox that very few people are tracking. If oil stays high, and inflation stays elevated, and the Fed keeps rates higher for longer, what happens to the U.S. economy? Growth slows. Unemployment creeps up. Consumer confidence, which the University of Michigan's March survey already clocked at 55.5, the lowest level since the start of the year, falls further. And when growth slows and unemployment rises, the Fed will eventually have to cut. That's the trap. They are stuck between an inflation problem created by a geopolitical energy shock and a growth problem created by high rates. Gold historically thrives in exactly this kind of environment. Now let me show you the disconnect that should have every person watching this video paying attention. Because we have a paper market telling one story and a physical market telling a completely different story. On the paper side, futures, ETFs, derivatives, gold is getting sold down as traders reprice rate cut expectations. Algorithmic systems are dumping contracts based on rate probability models. It is fast, it is automated, and it creates these sharp single-session moves like the 1.5% drop we saw today. The paper market is, in a very real sense, a pricing mechanism dominated by people who never intend to take physical delivery of a single ounce of gold. But on the physical side? According to the Vietnam-based report I reviewed this morning, on March 14th, today, long queues formed on Tran Nan Tong Gold Street in Hanoi as people lined up to buy gold. One major dealer, Bao Tin Min Chow, told customers that purchases of 4 taels or more could not be fulfilled immediately. They would receive a receipt and pick up their gold on March 25th. That is 11 days from now. A major gold dealer in one of the world's most gold-hungry consumer markets cannot fulfill same-day orders for larger purchases. That is a physical demand signal. That is real people making a physical decision to exchange currency for metal on a day when the paper price is falling. And this is not an isolated phenomenon. According to JPMorgan's data, bar and coin demand is projected to surpass 1,200 tons for all of 2026. That is not people buying paper claims on gold. That is people taking physical delivery of actual metal. There is a fundamental tension between what the paper market is saying and what the physical market is doing. And in every single historical episode I'm aware of, the physical market eventually wins that argument. Let me now walk you through the specific numbers that make this current situation so remarkable, and frankly, So instructive. Gold reached an all-time high of approximately $5,589 per ounce earlier in 2026, just weeks ago. It has now pulled back to around $5,023 to $5,042. That is a decline of approximately 10% from the top. In the 1979 to 1980 bull market, corrections of 10 to 15% were routine, and they did not mark the end of the trend. In the 2008 to 2011 run, there were multiple corrections in that range before gold ultimately reached its then record of $1,921. 10% from an all-time high, in the context of the strongest structural demand environment in recorded history, is not a crisis. It is a normal technical reset. Here is the bigger picture. 1 year ago, March of 2025, gold was trading around $2,989 per ounce. Today, even after this pullback, it is trading at approximately $5,032 per ounce. That is a 68% gain in 12 months. For context, the S&P 500's average annual return over the last 50 years is roughly 10% per year. Gold just did 68% in 1 year. And the financial media wants to spend their energy covering a 1.5% single-session drop. Now here is where the Fed narrative gets really interesting, and I want you to hold this thought carefully. The FOMC meeting is this coming Wednesday, March 18th. The rate decision will be announced. Almost nobody expects a cut. But what investors will be watching, obsessively, is the press conference, the dot plot, and specifically any language about the future path of rates. Because if Jerome Powell signals that the Fed sees the Middle East energy shock as a temporary inflationary impulse, and that their base case still involves cuts later in 2026, gold will respond immediately and sharply to the upside. Conversely, if Powell sounds hawkish, if he signals rates could stay higher for longer, gold could see additional short-term pressure. But here is what I need you to understand. Neither scenario changes the multi-year structural case for gold. Not one bit. The question of whether the Fed cuts in June versus September versus December 2026 is a trading question. The question of whether central banks around the world have fundamentally restructured their reserve strategies away from the US dollar toward gold, that is an investment question. And on the investment question, the answer is already decided. 3 consecutive years of central bank buying above 1,000 tons per year, 23 different countries adding gold in just the first half of 2025, the World Gold Council's 2025 Central Bank Survey showing the strongest intention to continue buying gold since the survey began in 2019. These are not coincidences. This is a coordinated structural realignment in how the world's official sector views gold. So what does all of this mean for you personally? And what should you actually be doing? I want to be very clear. Nothing in this video constitutes financial advice. I am not your financial advisor. Every person's situation is different. Please consult a qualified professional before making any significant financial decision. With that said, here are the practical implications of everything we've just covered. First, if you are currently holding physical gold or gold-backed assets, today's move is not a signal to panic. The data tells a very different story than the headlines. A 10% correction from an all-time high, in the context of the strongest demand environment on record, is not structural breakdown. It is technical consolidation. The people who sold gold during the 2008 liquidity panic, and the people who sold during the 2011 correction, and the people who sold during every other pullback in this multi-decade bull market, they all have one thing in common. They regret it. Second, watch the FOMC meeting on Wednesday very closely, not for the rate decision itself, that's a foregone hold, but for the language around the path forward. Pay attention to the dot plot projections. Pay attention to Powell's tone on the Middle East energy shock. Is he framing it as transitory, or is he framing it as a sustained inflationary threat? The answer to that question will set gold's direction for the next several weeks. Third, the technical levels to watch are the $5,000 per ounce psychological support level and the $4,996 key support identified by Light Finance's analysis. If gold holds above $5,000 into and through the FOMC meeting, that is a very constructive technical signal. If it breaks below $4,996 with conviction, the next level of significant support is in the $4,821 area. Neither of those levels, even the lower one, would change the structural bullish case. They would just be deeper discounts. Fourth, consider the geopolitical timeline. The Strait of Hormuz situation is fluid. Oil above $100 is not sustainable indefinitely without significant economic damage. When the conflict eventually de-escalates, and historically all conflicts eventually de-escalate, Oil will pull back, inflation expectations will moderate, and the door for Fed rate cuts will reopen. When that happens, the mechanical headwind that has been pressuring gold will reverse. JPMorgan strategists are explicit about this in their research notes. They see gold hitting $6,300 before the end of 2026. Fifth, the disconnect between paper and physical remains important. The cues in Hanoi today, the buying that is continuing across Asia, the bar and coin demand projected to exceed 1,200 tons this year. These are real people making real decisions with real money. They are not confused. They are not panicking. They are buying the dip. Sixth, pay attention to the US dollar. The dollar index, the DXY, has been the primary mechanical driver of gold's weakness. If the dollar peaks and starts to turn lower, as it historically does during periods of geopolitical uncertainty that ultimately get resolved, gold will benefit directly and immediately. Every 1% move lower in the dollar typically creates a corresponding move higher in gold. Seventh, give serious thought to the longer-term narrative. According to the Amundi Research Center and multiple other institutional research desks, we are in the middle of what they describe as a structural realignment from a US-centric monetary system to a more multipolar one. Central banks are not buying gold because they think it will have a good quarter. They are buying gold because they are hedging against a world where the US dollar's reserve currency status gradually erodes. That is a decade-long story, not a quarter-long story. And if you are going to position yourself for that story, a 1.5% single-session drop is not a turning point. It is noise. Let me bring this full circle because I want to leave you with the framing that matters most. $5,019 per ounce. That is the number that grabbed your attention at the beginning of this video. And yes, that is a real, painful 1.5% drop in a single session. I am not minimizing it. If you hold 100 ounces of gold, you lost roughly $15,000 on paper today. That is real money, and it deserves a real explanation. But here is what the people who panicked in 2008 did not understand. Here is what the people who sold at $1,900 in 2011 did not understand. Here is what the people who laughed at gold at $3,000 12 months ago clearly did not understand. The short-term move and the long-term trend are two different conversations. The short-term move right now is driven by a very specific, identifiable, and arguably temporary set of forces. A Middle East energy shock that pushed oil above $100, which pushed inflation expectations higher, which pushed rate cut bets off the table, which made the dollar stronger, which made gold cheaper in dollar terms. Every single link in that chain is reversible when the geopolitical situation evolves. The long-term trend is driven by the most powerful structural forces ever assembled in the gold market simultaneously. 3 years of central bank buying above 1,000 tons, the world's official sector actively diversifying away from dollar-denominated reserves, global gold demand hitting 5,000 tons for the first time in history, gold ETF inflows at near-record levels, and the world's largest banks, JPMorgan at $6,300, Deutsche Bank at $6,000, pointing to levels that would represent another 20 to 25% gain from today's price. The people who will be telling this story in 5 years are the ones who understood the difference between a shakeout and a structural reversal today. The signs are there, documented, on the record, in official filings and World Gold Council reports and central bank reserve disclosures. The question is never whether the data is available. The question is whether you are going to look at the data honestly, or let a single session's headline price move make the decision for you. I will leave you with one number. 1 year ago, $2,989 per ounce. Today, even after the crash, $5,032 per ounce. You tell me if the bull market is over. Drop a comment and tell me this. Which scenario do you think resolves first? The Strait of Hormuz situation or the Fed's next rate cut? Because the answer to that question shapes the next 3 months for gold more than anything else. I read every single comment, and the discussion in this community is genuinely one of the best I've seen anywhere on this topic. Your perspective shapes what I cover next. If you got value from this breakdown, please share it with one person who you think is confused about what's happening in gold right now. There are a lot of people out there looking at the headline price and drawing the wrong conclusions. And if you want to go deeper on the FOMC meeting, the dot plot analysis, and what Powell's language Wednesday could mean specifically for precious metals prices next week, I am covering that in the next video. Make sure you are subscribed and have notifications on, because that one is going to go live the moment the Fed announcement hits. This is not financial advice. Always do your own research. Always consult with a qualified financial professional before making investment decisions. The gold market is volatile, and past performance does not guarantee future results. But the data is the data, and today, the data is telling a story that the headlines are not.